Okay, welcome everybody to this month's episode of Lender Lowdown. I feel like in the last 4 or 5 videos, we have talked about so much like mortgage rates, high, low, loan programs, pulling from 401ks or retirement accounts, having seller cover your closing costs, whether to rent or to buy, refinances. And so I told Hailey today, I said, what if we just did your top 5 tips for just in general, like how to manage your finances? And so I know it's kind of broad, Hailey, and you don't know everybody's specific finances. So please, everyone, take this with like a grain of salt of like the full disclosure. This isn't exactly how it's going to go because we don't know your situation. But overall, if somebody was looking to buy a house in the first like next 6 months, 6 to 12 months, what are your 5 tips for them?
I love that question. And it's actually a question I get fairly often. So I think people just don't know. You just don't know what you don't know, like about any subject, anytime. And financing is one of those things where it's, like you said, very unique to the person. And so it's kind of hard to get an answer to that question without getting pretty invested, I guess, so to speak. So if you are considering buying in the next 6 to 12 months, like truly the best thing is to talk to a real estate agent and a lender. Just overview, kind of high level conversation. Wouldn't necessarily need an application, but just like, hey, this is what I do for work. I guess I'll just let you know, like, kind of how my conversation goes. Like, if somebody calls me and they're like, hey, I want to buy in the next 6 months, I'm usually like, awesome, great, let's talk 3 different things. And I say, let's talk, what do you do for work? So, what's your employment situation? Maybe you're retired. What's your pensions like right now? Maybe you're unemployed, maybe you're self-employed. What does that look like for qualifying for a house? So we talk income, and we like to see if you've had variable income. You need to see at least 12 months generally in your same position, or at least with your same employer with variable income. So that is one of the biggest challenges in terms of qualifying. But don't let that stop you. There, I would say, I'm just guessing, but at least 50% of my clients have variable income. So that's a very normal
Really?
thing not
Wow.
to be intimidated by. So that's one thing. And then the second thing is we always talk about credit. Where is your credit? And we want to know where your credit scores are. So if you're, 6 to 12 months out, you're setting yourself up so well to prepare, hopefully, and even get your scores better than wherever they are right now. Nearly everyone can do something to improve their credit scores. And one of my biggest tips that I like to share is credit utilization on your credit cards. Most people don't realize that you can pay your credit card every week, and it actually can be even more favorable to your credit scores than if you just paid it once a month when the bill is due. And
Really?
that's because you're keeping a lower revolving line or lower balance, revolving balance on that credit line or that credit card. So we want to see generally less than 30% of whatever your max limit is. And even less than that is good. So, like, if you're right around that 10% mark, that's great too. And so, for some people, that looks like maybe just paying it more often. Other people, you could even consider calling whoever you have your credit card through to increase your credit limit. Just ask the question. They may need some documentation. Oftentimes, they don't. And so, I would say it's a really good time if you're 6 to 12 months out, ask for an increase in your credit limit.
Mhm.
Another thing to really help your credit scores can be applying for a line of credit. So a line of credit is different. It will probably show on your bank statement as like a checking or savings account, similar style. And there's not actual card associated with a line of credit account, but it increases the credit that you have access to. And so it lowers your utilization ratios, which is really favorable. So if you have the time, it's generally free to set that up with a bank or a credit union, and just give them a phone call, drop into a branch, and ask what their requirements are for that. Generally, they will need to do a credit pull. So the further out, or the sooner, I should say, you do that, and then the more time you have between setting up a line of credit and applying for a mortgage, the better. You should have more credit history there, but something to keep in mind. And then the third kind of category that we like to chat about is assets. what is your current your cash position, whether that's your cash in your checking or your savings account, your cash in investment accounts or retirement accounts. Where are you at? How much do you have in reserves? How much do you have to put down? Even borrowers who are looking to use down payment assistance, if you have cash in reserves, like that's even better. Maybe you don't need to use down payment assistance to the full capacity that you have offered. Maybe you could just use a little bit. That could be really favorable for just interest rates, and insurance is connected to that. So many pieces are connected to how much cash you put in to your
Right.
mortgage, and your down payment. So, kind of those factors are kind of the questions that I go through with any client who calls, and then we talk and break down any questions that they have. So, feel free to come with questions. Feel free to do research. There's lots of wrong information out there, but there's a lot of correct information out there, and know that there's literally thousands of loan programs is what we call them, that you can be set up with as a borrower. So whether you're a first-time home buyer, an older person over 62, we have special loan programs for them. There's just so many options out there. If you're an investor, and you're looking to buy an investment property, maybe it's your first investment property, there's special programs that we can use for that. So just know that you're not limited. Feel free to do research, ask the questions, and make sure you're ready. You're ready when you're ready. Does
I
that help
think one of
answer?
the things that we talked about, I think it was in the last video or the video before, I'll make sure that I take it in the show notes, but it was just so interesting because you were like, maybe don't put all of the cash that you have towards that credit card or to
Yes.
pay off the car. Hold it and like ask a professional first to see how we can best leverage that for your situation.
Absolutely. No, that's so true and so important to not, run yourself out of cash just to pay off some debts. Or just, totally agree. I stand by that statement now. And the biggest kind of behind, or the reason why, I guess more behind of why I would say that is, some borrowers pain point or their pinch point, their limiter on their qualification is their debt to income ratio. And so their debt to income ratio would take into account whatever monthly debts you have, like a car payment or credit cards, those kind of things. And it could be, really favorable to pay those off, but to know exactly which ones to pay off and maybe not pay it off in full, pay it off in part, like all of those pieces is something that we figure after we get an application from a client. That's what I try to analyze and get just the right numbers for. And other borrowers, their pinch point is not the ratios, but it's really their cash. If they had just another $5,000, like they could, spend X amount more, whatever it is. And so it's hard to know exactly where your situation is until we get the application. We run through all of those pieces, and something we can do early on too. So if you are just 6 months out, I love to get an application, and I'll just hold your application. We'll do a quick refresh as soon as you're ready to jump in and start shopping. Now, the really nice thing and something to be wary of, so of course, I would love for you to apply with me for your mortgage, but for any lender, if you are applying, ask for a soft credit pull if you are more than 4 months out from purchasing. And that soft credit pull will not be a hard inquiry on your report. It shouldn't drop your scores at all. And so it's more favorable. It gives us all the information we need, kind of a preliminary report, and we can run all of our ratios based on a soft report. And so that's something I would do, like if we were 6 months out, get us all teed up and know exactly what we need to do when it's go time.
Nice. Okay, so you do encourage that because I feel like I have some buyers
Right.
sometimes
Absolutely.
and they're like, I don't want to do the hard credit pull. I'm not ready. But I mean, how many points does it really deduct from their score?
It really depends on how robust their credit profile is.
Oh,
Some borrowers will come back and say it's, a 15-point difference. Most borrowers, I would say it's between 5 and 10 points, which is
okay.
hardly anything.
Right.
It's generally more of a dramatic difference in the points that the hit is, the lower your scores are. So if
Okay.
you have higher scores, like something over 750, generally you're not going to see as much of an impact on your scores. And they generally do bounce right back within 4 months. So, and oftentimes even sooner than that, but I would say 4 months time frame for sure.
Sweet. Okay, good to know. But even then, like if you're 6 months out, just
Yeah.
ask for the soft credit check now, and then when you get closer to, you'll advise to when we would do the hard credit pull.
Absolutely, absolutely. And some lenders will ask for payment of a credit report upfront because it does cost us money.
Oh,
However, Fairway does not require upfront payment for any credit report for pre-approval. So just know that. Yeah.
nice. That's good to know. Anything
Yeah.
off the top of your head, or I would love to talk rates right now as well.
Go for it. Yeah. Yeah. We
Well,
can chat right.
they're low right now. They're like the
They're
lowest
low.
since they've been,
Yeah.
what was it, like something in 2023 or was it 2022?
Yeah, I think it's the last. Yeah, maybe it was early 2023. I thought it was 2022 since they've been this low. So
Yeah.
yeah, we're sitting right around 6%, just under 6%. I actually had a borrower who really wanted to buy down her interest rate, and we locked her at 4.99. So
Wow.
that was really exciting. She was just like, she's a little bit older borrower, wants to pay off that loan as quickly as possible. And she was just like, I know I'm not going to, she wasn't planning to refinance, after this. So yeah,
So let's see.
we
Yeah,
have options.
we had our sales meeting on Wednesday and I saw those rates and I was like, holy cow. So then my question to you, I feel like some people are still, they're like, hey, if I see X amount of number, I'll jump back into the game. But then some of them are still like, well, it's an election year and we don't know what's going to happen. So when you get the question of like, or the statement of, we don't know what's going to happen, how are you advising your clients right now?
That's a really good question. I love to go back to like why does a low interest rate matter to them? And it matters to them because it's connected to their monthly payment, right? And so that's the biggest factor. I was like, okay, if you continue waiting, but your monthly payment comfort zone is $2,000 a month, like
Mhm.
what can that buy you today? Would that buy you something that you want? If you continue waiting, how much more could you save? What more
Mhm.
could it buy you at a different interest rate? So I love to run side by side scenarios based on their monthly payment. Like, okay, your monthly payment goal is the 2,000. At this interest rate, this is how much you could buy. At this interest rate, this is how much you could buy. But the interest rate is not the only factor that changes your monthly payment, right? So if you have more cash and you have more of a down payment, that will change your monthly payment. And
Yeah.
so it's like maybe we pull a little cash from their 401k. We set a number of like 10,000. Like, okay, if you had $10,000 more in your savings account that you put towards your down payment, we would hit that $2,000 a month goal.
Right.
Maybe it is a down payment percentage amount. Maybe we're going from 10 to 15% and it drops their mortgage insurance enough that they hit that $2,000 goal.
Wow.
So there's a lot of different things that we can push and pull to hit that $2,000 goal. That's not just the interest rate, which we have
Mhm.
limited control over. Other times it is about buying down that interest rate. Like if we could buy it down to 5.25, but today's 0 point interest rate is 6.25 for that borrower, then it's like, how much does that cost? Could we
Mhm.
get the seller to pay that for you? And then all of a sudden we're at 5.25, we're an entire percent lower, we're hitting the monthly payment goal. It's more than just the interest rate. So that's what I like to advise borrowers is let's talk strategy around how to hit your payment goal. And that's really the biggest thing that we need to focus on. And of course, the second, almost as important, is your cash to close goal, right? Like how much cash do you have? But really it comes down to payment for most borrowers.
Well,
Does
and
that
I
kind of
will
answer
just
your
like
question?
piggyback on that. One of the reasons I was so excited to see that is just because I've had a couple first time home buyers right now. And the prices, there are some houses that have been sitting that started too high. And so now they've kind of got to divvy down. And so, like, we're in a position in the market to where, like, interest rates just came down to like a great number and there are deals to be had. I am hearing right now like in 400 and below, like that's where I really think that the deals can be found. In that middle range of like 400 up to 700, things are really kind of sitting. It's really interesting to watch.
Yeah.
And then above that, for people that have the additional cash or are trying to make big moves in their lives right now, things are moving if they're strategically priced. So it's not, I don't think we're in a place in the market right now, and tomorrow could be different. So don't quote me. But interest rates typically come down and home prices go up because a slew of buyers come and enter the market again. Right now is still where I feel like you could really take up on the advantage of, okay, I'm going to get the interest rate that I wanted or that has worked better than the 7 or 8 that we were seeing a couple months ago. And I can find a house that needs a little bit of work that's been sitting on the market for a while. Sellers don't want to hold on to it going into the winter. So let's come to a deal.
Yes. Oh, absolutely. Yes, yes, yes. And so I have a couple borrowers who are refinancing right now who were at the high 7% interest rates when they purchased last year. Yeah, most of them last year. And now they're refinancing into like the low 6% interest rate. And that's awesome for them. But there's a good chance that the interest rates will continue to come down through next year. And so if they do, and we, hit the low 5s into the 4s, which is a chance, then we could refinance again. So that's the other thing. That's, what I'm hearing at, family gatherings and that kind of thing is, oh, would interest rates drop again or further, would you advise refinancing now or later, or purchasing now or purchasing later? And of course, it comes down to your monthly payment where you feel comfortable. But also, I can run the numbers. Like, what would the change be if we were at that lower rate? Exactly how many dollars a month would that be for you? And for some borrowers, that's only $60 a month or something different, which is fairly minimal. For other borrowers, it can change a couple $100s. And then it's like, okay, that makes a lot more sense to wait longer.
So depending on the situation, though, you are advising some to refinance now because, again, none of us have a crystal ball. We don't know what's to come. But then if they came down even further to a point to where it did make sense, you would just encourage another refi.
Yes, yes. And generally the rule of thumb is an entire percentage point lower. So if you're going from, like I have a borrower, at 7.25 going to 6%, and if that 6% all of a sudden could be, 5%, then it's like, oh, well, that might make sense again. But just keeping in mind that might not happen. So you want to be comfortable wherever you do end up settling. But the difference between 6% and like 5.75 is very small. On their monthly payment. So just something to note there.
Yeah. Do you have any programs to where like it's a one-time fee to refinance, or would you typically suggest that it's typically 3% to get the purchase price, right? Or the value of the home?
Yeah, it can be. Yeah, it really, a huge part of the cost of the refinance will come down to how low you want to buy your interest rate if you want to buy it down more than what the no cost interest rate would be. And so that can add thousands to an interest or to a refinance. But yeah, generally, even just in the 1 to 2% interest or of the loan amount range for a refinance. But we do have a credit, lender credit that we're offering for refinances right now. And especially for borrowers who've purchased with us, we have a really favorable credit. And so just kind of, offering incentives, we understand that it, is favorable for you. The other like cost analysis that we like to do is compare the cost of the refinance to your monthly payment savings. And if you divide, your cost by your savings, you can know when your break-even point is. For some borrowers, that's years down the road. If they spend a lot on the refinance and buying down an interest rate, some borrowers, they break even in 7 months and they're like, oh, I'm on the cash flow positive for my monthly payment being so much lower. So just things to consider, things to analyze. I will say, refinances are very profitable for most lenders. And so they will be pushing refinances. So just to be mindful and, as a consumer, to be mindful of what that cost analysis looks like for you.
So to get concrete numbers, talk to you.
Yeah. This is all
very
for sure. I'm absolutely happy to help with that. Yeah. It's so different per situation. It's so hard.
Yeah. Well, I feel like that was so much great information. Is there anything on top of that you wanted to share?
I don't think so. I think the other part, and again, this is just tying back to refinances because that's like so common right now. A lot of topics, I guess, or conversations around refinances, I should say right now, is appreciation of your home. And so for first-time home buyers, refinancing shortly after they purchase the home can be very tricky if they did the minimum down payment. And so things to build like equity in your home, and just kind of the market appreciation of your home, you may not actually have an opportunity to refinance right away. I should say refinance with no cost out of pocket. So
Sure.
most of the time we like to build any costs associated with a refinance into the loan amount, so the borrower does
Mm.
not have to come out of pocket with any money to refinance. Now, you would have to have some equity in the property to make that work. And so just be mindful if you're like, hey, I do plan to refinance as soon as I see rates hit 5.5 or 5, whatever your magic number is, be also considering what you could do to add value in your property, build equity in your property, whether that is, painting or, gravel in a driveway, or like a new roof, but updated kitchen, like crazy big things too.
Just
But
water
whatever
your lawn. Some people don't
or
water
water
their
your lawn. There
lawn.
you go. Yeah, exactly. So there's lots of things you can do to add equity. And what I recommend right now, and I have done this with every borrower that I've had closing in the last 12 months, is I say call the real estate agent to help you purchase and ask them what you could do to help with your property value.
That's
And
great.
agents are so good, so knowledgeable on how to do that. And I know, Emily, you're a great resource for that too. So I would say that's something to keep in mind if you're like, hey, maybe I will refinance later. What can you do today or in the next couple months to set yourself up for more success there?
Yeah, I love that.
Yeah.
Think long term. It's not always right
Yes,
now, but if you get started now, it's easier typically down the road.
it is for sure. Yes. Well,
Well,
I think that's all I
awesome.
have for now. I have so many things. I love
No, it's
mortgages. I love
great.
real estate.
Write them down and save them for next time.
Yes,
And
yes.
for everybody else that's listening, like we had talked about some prior videos that we've done, and really even just the concept of today's video came from like all of the subjects that we have touched on. So this and overall was kind of a summary, even though it didn't really feel like a summary. I felt like we got into details and I loved it. But make sure you go back and watch prior videos as well, because Hailey, as always, is a great resource and just has all of the tips and tricks. And I love to hear it. I learn something every time. So until next time, thank you, Hailey.
Yes, thank you for having me.